Just a moment. All right, so today's let me display. I want to present my screen. Yeah, the lecture has started. I just want to present my. I want to display my screen here. So once you can see my screen, just let me know. Type 222 in the chat box. Once you can see my screen, type 222. Sorry, this should not be. I'm displaying PPT for week 4. This should be for week 5. So I'll close it. The PPT should be for week 5, not week 4. So let me close. Let me stop sharing. Just a moment. I should have week 5 PPT and not week 4. Okay, I guess that was a typo error. Because what I'm having there is even the topic for today. So yes, that was a typo error. Let me do that again. Okay, I'm sharing my screen now. So once you can see my screen, you can go to the chat box and type 222. This class is going to be very, very interesting because these are very interesting topics that we are looking at today. So just go to the chat box and type 222 once you can see my screen. Let's do that quickly. I need 222s. Good. Mr. Femi, thank you very much. It seems I used to see your face very well. One of our very, very, let me say, close attendees, right? So thank you very much. Sir. I'm getting only one. Why is it I'm getting only one? I should get about 10. We have 22 people on call. So I should get about 10, if not more than. Let me see. I'm seeing only two people typing 222. Okay, it's a bit fair now. All right, let me get 5 more so I'll know I'm good. So we have 1, 2, 3, 4 already. Thank you, Mr. Edo Abiodun. I can see. Let me see. Grace, I know. Okay. Joseph Okaba. Thank you very much. Well, now let's go. We have 22 people on call. So let me get 2 more, 3 more. So I'll know that you can see me. We can all see. Go. All right. So that aside, we're in week 5 already. Don't forget that we are going to week 12. We're in week 5, or in fact, we're almost in mid-diet. Now, before I begin my class today, ask yourself, what's your preparation level? How prepared are you for the exams? I said in one of my classes that if you are taking 5 papers, you have no reason at this point to not do at least minimum of 4 hours a day. Minimum of 4 hours a day, right? If you are writing 5 papers, now it's no longer a matter of joke, because I see many people being lackadaisical that the exam is still far off, and we are almost in the mid-diet week. Next week is going to be our mid-diet week, so I hope we are all prepared for that, because it's going to be a revision of what we have done so far. And so far, we have done a whole lot of topics. I think we've covered about 8 to 7 standards, if I'm not wrong. As such, today we'll be looking to other important standards. Please, if you are going to be joking with any standard here today, if you are going to, sorry, this should not be IFRS 12. This should be IFRS 2. What's happening today? Oh, it's for my hand. Probably I was in a hurry when I typed this. So this should be IFRS 2. IFRS 2. All right. So please, if you are going to joke with anything that we are going to be looking at today, do not joke with IAS 19. I know why I'm saying that. IAS 19, do not joke with it. I'm not saying you should joke with any other one here. But if you are going to still look at, I want to joke with any of the standards here, do not joke with IAS 19. I'm making repetition on it, because this standard is one of those core areas I spoke about. If you remember in one of my classes, that ICAN do not joke with IAS 19 employee benefit. It was not testable when you are at the skills level, but at the professional level now, it is very, very examinable. It is highly examinable, right? So that's employee benefits, IAS 19. Then we have IFRS 2, share-based payments, and then we have IFRS 13, fair value measurement. All right, so one thing I used to do is I like to talk about, I'll major on a particular standard today. I will talk very well, like I will expatiate on a particular standard, right? And I'll just like talk briefly, like summarize the remaining. You must have gone through the standards or this particular class before the videos before this particular class. So that's why I would not dwell much on some of those standards, right? So IFRS 13 is fair value measurement, right? Fair value measurement. And IFRS 13, fair value measurement. IFRS 2, that's share-based payments. And we also have IAS 19, which is employee benefits. All right, so let me start with IFRS 13. Many of us have heard of IFRS 13. Many of us have heard of one way or the other, you must have heard of IFRS 13. The thing is, please do not joke with this class. I might not go in depth with some of the things I'll talk about today, but everything I'm going to talk about will be very, very useful for you. Just have it at the back of your mind that you are going to leave here with something, right? And if you have not gone through the video lectures, that's in chapter 14, 15, and 16, please do so. I used to beg you, please, so that you'll be ready for this class. Because if you had gone through this chapter 14, 15, and 16 in your video lectures, you would have been ready for this class. In fact, most of the things I'll be talking about will just be like a revision. That's why we do encourage that you have actually gone through the video lectures before the class. Now, having spoken about that, please, I beg you, ensure that you have your writing materials, because I'll not repeat some of the things I'll be talk to the admin. The admin will have this particular record for you, so you could actually rewatch. But those of us that don't have the opportunity, that might not want to actually do that stress of rewatching, please get your writing materials with you, because I will be doing just a brief summary of the two standards, IFRS 2 and IFRS 13. But IAS 19, if time permits me, I will expatiate a whole lot on it, because don't let me lie to you, the first time I heard of IAS 19, the first class I attended, I remember I was in the professional level, I attended IAS 19. I did not understand. It's got really complicated and all of that. There are some standards that over the long run, you might get to understand them. But if you hear them for the first time, it can get really complex. I'm not trying to scare you or something. IAS 19 is one of those standards that when it gets tested, it is one way. ICAN don't have anything to test under IAS 19 again, right? It's always one way. We know, in fact, we as a person, we know what they can actually test under IAS 19, right? They don't have much, I won't say they don't have much question, although they can actually lock some aspect and all of that. But we know that, okay, where they will test is usually so area, defined benefits, right? Defined benefits. That's the area. Those of us that have gone through the video lectures, you understand what I mean? That's where they will usually come from, right? Where they will tell you to do remeasurement, current, past cost, and all of that. We are going to talk about each of them today. Even though we might not be able to solve a question, right? But you will understand what I'm going to do is that I'll give you a leverage that'll make you be able to, that'll enable you to be, that'll make you see questions that you can, the questions, it will be very easy for you to treat, or it will be very easy for you to complete, to actually comprehend them. So that's what we are going to do. Now, let's quickly talk about IFRS 13. I'm very sure many of us must have been hearing of IFRS 13, but in another way. The reason why I said must have been hearing of IFRS 13, fair value measurement in other ways, that don't forget that in IS, that I don't want to talk about, okay, in IFRS 18, presentation of financial statement, ICAN made mention of something, or let me say conceptual framework. They made mention of something that, as regards measurements, our presentation of elements of the financial statement. Now, if you want to present them, are you not going to measure it first? Then you look for how you then present it. So if you are recognizing a particular element of the financial statement, whether it is expense, whether it is income, whether it is an asset, whether it is a liability or equity, then there should be a method that you should be able to capture it into the financial statement, which makes us talk about measurement. Now, when you are doing this, there are different ways in which you can actually do measurement. We've seen historical costs, we've seen evaluation, we've seen at disposal cost, we've seen at value in use. There are a whole lot of bases that you can use to capture in those particular items that you have actually recognized in the financial statement. Now, if you are attaching figures to those particular items, that's what you are doing. You are talking about measurements. If you say, okay, this particular item qualifies, this particular television or this particular laptop qualifies to be on the face of the financial statement, then what you should be asking yourself is, which figure are we going to use to record it? And that talks about measurements. Now, when we are looking at measurements, there are various bases of measurement, right? And the reason why IFRS 13 saw the need to actually expatiate on IFRS 13 is because of many people have been using fair value in a very wrong way. Fair value is one of the bases that you can actually use to carry elements of the financial statement in the financial statement, right? So fair value came into place, fair value measurement came into place to actually deal with how people use fair value. Now, when we talk about fair value, what is fair value? If two of us come together now and I tell you, fair value, there was a particular debate that we had then between, a colleague and I, we're actually having a conversation. I like to involve myself in so many debates that maybe fruitful debate. Or let me say, I would say it's a debate. It was actually like an argument, but it's not a blind argument. It was actually an argument that was educating and insightful, right? And he was of the opinion that fair value is actually very subjective. And I said, yes, I agreed, but it's not subjective because IFRS 13 has played a major role in IFRS, in fair value. Now, if you say fair value is the amount, because of just pay attention to the way fair value, the standard defined fair value. The standard defined fair value as the amount. Let me, I don't want to do copy and paste of the way they actually defined it. I will tell you what IFRS 13 defined fair value as. IFRS 13 fair value said that if Mr. Femi Oni and I come together and I like the phone with him, right? And I like the phone that is currently with him. I don't know the phone he's currently using. And I tell him, oh, I like your phone. How much did you get your phone? And he tells me, oh, he got his phone 200,000, or let me say 500,000. I don't know the phone he's using, right? And he tells me he got his phone 500,000. And I tell him, okay, because of, you have actually used this phone, you have brought it, you have done so, I don't know, you have used it for maybe some months or some years. Now I'm presenting you, I'm offering you 250,000. Will you sell this phone to me? If Mr. Femi Oni agrees to sell that phone to me and at that particular date, then that's the fair value measure. IFRS 13 says that particular 250 is the fair value for that phone. Now, will you now tell me that because of Mr. Oni sold that phone to me, 250,000, I now see that phone with someone else, and I tell the person, someone should not say, okay, I now went to tell my friend that, oh, I bought this phone for 250,000. If my friend goes to the market and says, oh, because of I bought this phone 250,000, me is referring to me that the seller puts it at actually maybe 500,000. He tells the seller that, oh, because of me, I have gotten my own phone at 250,000. The seller needs to sell the phone to him at 250,000. What do you think is happening there? That is telling you that fair value is subjective according to the definition of fair value, IFRS 13. Now, what is that definition? I've actually pictured it to you, the way IFRS 13 have actually defined fair value. Now, IFRS 13 have now defined fair value as what? As the price. Fair value as the price. I'm coming. Just a moment, please. So IFRS 13 was able to define fair value as the amount that two market participants can exchange a particular asset or liability or anything you may call it at a particular measurement date, right? And where those particular conditions or those terms of transfer are actually at market, at a fair, let me put it at they are the market, let me say at a measurement date and at a market fair rate, like at the arm's length transaction. Okay, that's what I'm trying to actually look for here. Yes, at arm's length, exactly. That's what I was trying to like look for there. I don't like to define standards the way they actually define it. I like to understand it the way I like to understand it. I don't like to define because I don't like to cram standards. That's one of the things that I like to encourage students. When you see a standard, tell you, okay, this is the definition of this standard, this is of these terms. I used to say it over time that ICAN will never test you for how you can quote the standard word for word. Are we making any sense? ICAN will never tell you, oh, tell me what's the definition of this. They want to see you that do you understand what this standard is talking about, right? Are we together? They want to understand that, okay, this standard tells you to do so thing. This standard tells you to do so thing. What can you see about it in your own words, right? So that's what they are. Nobody will condemn you if you define it in your own words. That means that you understand this thing. That's why you're able to define it in your own words, right? So that is what we are trying to look at here. Now, looking at IFRS 13 is like I used to say something that is very important whenever you are looking at a standard. It's very important for you to look at, okay, their measurements, their IFRS 13 does not have recognition. It does not have I said their presentation, their recognition, measurement, maybe subsequent recognition, and maybe disclosure. But when it comes to IFRS 13, the standard itself is trying to explain a particular concept in some standards. Many standards you see, many standards telling you that, oh, fair value, fair value, fair value, fair value. Now, this standard is trying to make you understand what is that fair value. Let's regulate the way you use this fair value, right? So it is the price that will be received or to sell an asset or paid to transfer a liability in an orderly transaction between market participants measurement period. The reason why we are stressing the measurement period is because of circumstances. Tomorrow, if I go there, that person may decide not to sell it again. Mr. Femi Oni may decide not to sell that particular phone to me again because of circumstances have changed. That's why we said it is at a particular measurement date. Now, talking about measurements of fair value. Yes, talking about a particular measure, talking about the measurements. Now, there are some key concepts with respect to IFRS 13. We have the definition of the fair value, we have the measurement, we have the principal market, then we are going to talk about the most advantageous market. Now, talking about measurements of fair value, measurement here in fair value measurement is based on the assumption that market participants would use in the price, we use in pricing the asset or the liability. So we are looking at, when we look at measurements, we are looking at what is the price that you will use, or what is those particular assumptions, right, that the market participants will use in pricing that particular asset or that particular liability. Now that's what made us talk about the principal market. You may think this standard cannot be tested, but it has been tested before, even though it's not very frequent. It has been tested before, and these are the things that they tested. We have the principal market. Now, when I talk about the principal market, that's the market with the greatest volume and the level of activity for the asset or the liability. So you can decide to use the principal market, or you can also, the second one is the most advantageous market. If you don't want to use the principal market, you can decide to use the most advantageous market. That is the market that maximizes the price received for an asset or minimizes the price paid for a liability. So if you decide not, for example, now let's look at this. Let's look at this very well. If I say I want to actually purchase an asset, right? Or let me say, let me just use, for example, I want to purchase a laptop now. Now, I want to look at what is the fair value of this particular. Please, I don't know who's having their mic on. Patrick Ibodo, please, can you just mute? Thank you so much, sir.
Okay, thank you.
I don't know who is this. Yeah, thank you. Okay, so if you're actually going to be looking at, let me still stick to the phone I want to buy. I want to buy this phone now, right? And I'm looking at what's the fair value for this particular phone. I can decide to go to Computer Village. Now, in Computer Village now, many of us would know Computer Village. I decide to go into a market that has that particular asset that I want to buy, or that particular liability that I want to transfer, on having it on the greatest volume of activity, right? Many of us know that if you go to Computer Village now, you see that that phone is being sold. That particular phone I want to buy, you will see that they say, we just sold this phone very well. We used to sell this phone very well. We sold it yesterday. It's having a volume, the market with the greatest volume and level of activity for that particular asset or liability. Now, that's the principal market. So if I go to that market now, I can decide to go, what is the price that they are selling that particular phone in that particular market. Now, if I can just take, okay, I go to these slots, I go to 3CUp, I go to different places in that Computer Village, and I benchmark all their prices. Okay, one is selling it for 250, one is selling it for 300, and that person is selling it for maybe 400. I can decide to get the average Now I've gotten, if I now divide it by 3, because I got it from 3 stores, then I can say the fair value of that phone using the principal market is that so amount. I don't know if I'm making any sense at all. Now, if I now want to get the fair
Yeah.
value using the most advantageous market, I'm looking at the market that maximizes the price received for that particular asset or minimizes the price paid for that liability. Now, this particular advantageous market is talking about the market that will make you earn the most if you are going to sell that asset, right? I can go now and say, okay, if I go to Lekki, how that same phone that they are selling for 250 there, I go to Ikoyi, I can sell it for maybe 1 million. Ikoyi can be the most advantageous market then, right?
Okay.
Are we making any sense at all? Or if I say,
Very
okay,
well.
if I say, if someone tells me, you know, this particular asset that you are selling here now, do you know that you can sell that same asset overseas for an higher price? So I'm looking at the most advantageous market. That's what I want to use to do my benchmark for fair value. Are we making any sense at all? So
Yes, sir.
that's that for that. Please understand all of these principal markets, most advantageous market. Now there's something called fair value hierarchy. Whenever we are doing using fair value measurement, there's level 1, we have level 2, then we have level 3. I will not really dwell much on this because it has been properly explained in video lectures. For level 1 talks about the quoted prices in an active market for identical assets or liabilities. I don't know, many of us here are doing many of us here, I believe you are doing SFM, or you must have done SFM, or you are still going to do SFM. There's a particular topic that was introduced. I don't know why ICAN has not tested that topic yet. I don't know why. It is international valuation standards. That topic is called international valuation standards. And I'm telling you that if you have read that topic in and out, you understand most of all the things that IAS is talking about, or the IASB is talking about with respect to IFRS 13, right? So there's something called level 1. Level 1 is the price. If you okay, for example, now if I want to sell a particular asset now, I can go and check the amount that they're actually selling. If there's a particular market, a quoted market now that sells similar assets, I can go and check the price that is being quoted for that asset on that particular market. That means that there's a readily available market for that asset. So the amount that they are selling that particular asset in that readily available market are level 1 prices because of they are the quoted prices in an active market. Because there are some particular liabilities, there are some particular assets that do not have an active market, a particular active market for them. Are we making any sense at all? So there's no active market. So when that particular asset or liability has an active market, then it is a level 1 fair value price. Are we making any sense at all? So level 2 now are observable inputs other than level 1 prices. Now, when you talk about those observable inputs, you can talk about interest rates, you can talk about the credit spread, right? So the particular quoted or active market for it. You are just trying to observe, are there similar particular interest rate? Probably, for example, now I want to sell, like, let me say I want to sell shares now, and I'm looking for, okay, which of this particular market has similar spread for the shares I'm trying to sell or the particular financial instrument I'm trying to sell. So you are looking at observable inputs. You are not looking at the active market. You are looking at observable inputs, like I gave the interest rate or the credit spread. So that's what you are trying to look at. Okay, this particular asset now, does it have, I don't know if some of us have treated, you see, at times you treat a question in SFM. That's why I used to advise students. If you are writing CR, it's always good for you to just write SFM2 with it, right? You see, I don't know, this is, I'm putting a particular disclaimer to this. If you want to write 3 papers in the professional level, please, you are left to choose whatever. I don't say I'm the one that advise you. I'm talking based on experience. I'm talking based on experience. If you want to write 3 papers at the professional level, please ensure you write corporate reporting and auditing together, firstly. Then, if you are writing 3 papers, ensure that your first 2 papers are corporate reporting and audit. Because if you read corporate reporting alone and you do not write audit, by the time you are writing audit, advanced audit, you will still come back to read corporate reporting. Do you know why? Because of when you are treating advanced audit and assurance, you will still need some particular standards. Don't forget, when you are planning your audits at the inception of your audit, ISA 200, planning of the audit, you will need to quote some particular standards. I know you must have started doing all of this in your advanced audit. You will tell them that, okay, to audit this particular entity, we need understanding of this particular standard. So imagine you did not read, you did not do CR. You still need to go and do CR. I'm telling you, because of CR, there's a particular saying that all accountants are auditors, but not all auditors are accountants. Because of you need to be an accountant firstly before you can be an auditor. So you tell me you are not writing CR and you are writing audits. You are just deceiving
Audit.
yourself. Don't let me lie to you. Write CR and audit together, because you will read. If you do not write CR when you are writing audits, you will need to read CR when you are writing audits. And if you do not write audits when you are writing CR, well, it's when you are writing. If you write audits when you are not writing CR, then you might not need to read audits when you are writing CR. I don't know if you understand what I'm trying to say, but they are complementary. They go hand in hand. Now, the next course that you need to take when you are writing, if you want to take 3 papers, is SFM, because of at times when you are doing SFM, you see cost of capital. Tell me, don't you use cost of capital when you are doing corporate reporting? Is it because of we call it finance cost? Finance cost is also cost of capital. Don't you understand? Is it because of don't you use ratios? Don't you use ratios when we are doing valuations? You are using EBIT. When you are using EVA, economic value added, don't you use profit before interest and tax? Don't you use economic? See, if you are doing SFM, don't even look at it. Write corporate reporting also with SFM, but it still depends on your level of what you can actually carry. So that's why I advise all of these things, that it's still left to you. There's no principle to all of these things. Do you get? So that's why I always put that disclaimer that there's no principle to it. Some people can write CR and SFM separately and they'll still pass. So do what pleases you. But we are just trying to give our own professional advice based on what we have been doing for years now. Do you get? So what's the trend? That's why I'm just trying to. So let me just go back to and round off on IFRS 13. Time is really flying. So before I can move to, I might not even deal with IFRS 2. So I'll just talk about IAS 19. I want to major on IAS 19 because many times I've been opportunity to record various pathfinders. And I always look at, whenever they test IAS 19, I always look at the examiner's comments. It's always very poor. Why? IAS 19 is one area that ICAN keeps testing, and whenever they test it, the examiner is always complaining that performance is poor. What is happening? Why are we dodging IAS 19? Why are we dodging it? It's very easy to understand. It's very easy to comprehend. So now let me round off on, I spoke about the observable inputs. That is the level 2. Now level 3 is unobservable inputs. That is assumptions.
Observable input, non-observable input.
Yes, which is level 3. So unobservable inputs, like for example, we have the future cash flows, right? Now, when we look at unobservable input, it is peculiar to entities. It is peculiar to each market participant, because of, you cannot tell me that this particular the way I want to value this, place fair value on this particular asset. If I'm looking at the cash flow, can they have similar cash flow with the way I'm going to value it if it were to be from other market participants? They will have different cash flow or expected future cash flow. They will not have the same trend. It's just like looking at, okay, what is the future? If I'm looking at this laptop, what do I feel the way I'm using this laptop? How do I think future cash flow accruing from that laptop will come? Depending on what I'm using it to do. I'm using my laptop to lecture now. Financial level 3. Now, the most prices. You know why? Because of it is already somewhere, and it is usually regulated. Quoted prices on an active market. For example, now if I say, okay, I want to buy shares of GT Bank today. GT Bank is quoted now, so I can just go to the stock exchange market and look at what is the price of GT Bank as at today, and maybe I'm buying it from a secondary market. Maybe I'm not buying it directly from GT Bank. GT Bank sells their shares today that directly as I think 44.5 kobo, 44 naira 50 kobo as at today. But if you go to the secondary market, you could actually sit at a different price. It is quoted, so there's an active market. You don't need to observe anything. Moving on, there are some disclosure requirements with respect to, IFRS, IFRS 13. So things you must disclose the fair value measurement, that is the amount that is recognized in the financial statement. 2, the methods and assumptions that you have used to determine the fair value. Have you used a level 1 fair value hierarchy? Which one have you decided to use? Is it the principal market or the most advantageous market? Are we together? So, and lastly, you must actually disclose sensitivity analysis. What do I mean by sensitivity analysis? How changes in assumptions affect your fair value. If your assumption changed today, what is going to happen to the fair value that you have recognized? Are we together? So that's the sensitivity analysis. Now, that being said, let's quickly go to IAS 19. Now, look at IAS 19. It talks about employee benefits. Now, when we talk about employee benefits, you are working today, you are working for something, right? Because of you want to earn something. And any benefits that you are getting from your employment is known as employee benefits. So we are talking about all forms of consideration given by an entity in exchange for services rendered by the employee or for termination of services. Do you know that provisions, IS 37, I don't know, since we have considered that, or if we have not considered that, we are going to look at it. Provision says that if there's a provision for restructuring, I don't know if you have actually considered that. Provision for restructuring says that in a situation whereby you want to restructure, you should have carried along all those that will be affected by that restructuring. You should have considered them along. And if you have actually included in a clause that if you are going to terminate the employment of a particular employer, you need to provide termination clause. You need to pay for that termination, right? I don't know if many of us are familiar with the way it is done in European football, or not only European football, anywhere in the world. I don't know if you see that they sack a coach. Many of us that are football lovers will know this. If you sack a coach today and the coach is still having an active contract, you need to pay a termination clause. That's why you see that these days, whenever they want to sack a coach or they want to terminate a coach contract, they will tell them that, okay, let's find a mutual agreement. That's why you see that he has mutually left, because they are trying to beat that clause. They don't want to pay that clause, right? But if they terminate that clause and say, okay, you no longer belong to us, you no longer coach us, they will need to pay him that termination clause. And that termination clause is also an employee benefit. Are we making any sense at all? It's not only the one that you are getting because of many people think, when you talk about employee benefit, because of your salary, your wages, they are part of it. But even when you are no longer working with them, if they have actually promised you in your contracts, your employee contracts, that they will give you this particular package, then it becomes an employee benefit. Are we making any sense at all? So now, please, let's note that a company may reward its employee in any way other than payment of basic salary, like I said. Now, employee can actually provide entitlement like maybe paid holidays. They are also employee benefits. Payment of annual cash bonus to some employees, even provide provision of company car, medical insurance, pension benefits. All of these, they are all employee benefits. Even some particular employee can also receive share options under the company pension scheme. Some can even also still, which, if I want to know if you're actually watching the video lecture, in a situation whereby the employer promises the employer promises the employee to receive share options under the contributory pension scheme. Under where can we treat this? Under which standard can we treat this? I want to see if you're actually watching our video lectures. If the employer, okay, I as the employer, I tell you, okay, if you attain some particular thing, or you stay with this particular company for a particular period of time, or you attain a particular profit or a particular condition, I'm going to give you shares in my company, right? What standard treats this? If you know this, just unmute and tell me, please. I want to know if you are following. Someone said IS2. IS2 is even 3.
IS10, no?
No. We have not been reading, though. IFRS 2. Thank you so much, man. Share-based payments. Share-based payments. If I tell you that, I promise you that, okay, I'm going to give you shares based on some particular condition. There are some vesting conditions that you must meet. right? And we must assess it every year to see if those conditions are still being met. So we need to recognize it, right? So those particular, that's why IS 19 have said that if the employer promises you that he wants to give you, there are two types of share-based payments. I don't know. I don't want to. I said I don't want to treat share-based payment. I don't want to digress on it. So I'll leave it to you. If you want to, if the employer promises you that okay, he wants to give you a shares based on some particular condition, maybe probably you are, if they tell you okay, you need to stay with the employer for so number of years, so and
I can't
all
hear
right.
you,
So
Sao.
sorry, no. I lost my connection for a while, so I'm back now.
Wow.
So if in a situation, maybe in a situation that you have your share-based payment, maybe you have the employer has promised you that okay, he will give you shares in reward for so conditions and all of that. Now IAS 19 says I'm handing up or I'm handing over to IFRS 2. That's me, nothing concern me with that one. That me is outside my own jurisdiction, is outside my scope. I don't know if many of us have noticed that standards usually say scope. They used to give them their scope. So they say that is
Yeah,
not within their own scope.
what they can cover,
That's yes,
the extent
exactly.
of
So
coverage.
exactly. So IFRS 2 is what is going to treat any of this particular situation where you have the employer promising the employee that oh you're entitled to shares. Okay. So now let's move on. Let's move on quickly. Now, why do we need IAS 19? Ask yourself. You know, IAS 19 provides guidance on accounting for all forms of employee benefits except from share-based payments. Please do not forget, which is treated under IFRS 2. And the standard classified those employee benefits into three. So we have three employee benefits. We have the short-term employee benefits, like wages and salaries, maybe non-monetary benefits, like maybe medicals, leave bonuses, car and all of that. Two, we have post-employment benefits and other long-term benefits, which can include pension, life insurance scheme, post-employment benefit like medical. There are some particular companies that even when the employee is no longer working with them again, they still give them HMO. How many of that are in Nigeria? I don't know. I've not really heard of, but it's very common. It's very common outside Nigeria.
In the US,
Even when
yeah.
that you are no longer working with us again, we still provide certain non-monetary benefits to you. Like, and we can also have some long-term post-employment benefit, like maybe disability leave benefits. We can also have long service leave, sabbatical leave, and all of that. And the last one is termination benefits. Now, this particular, I explained this earlier on that it is as a result of termination of employment. That was what I used the coaches in football to explain. And please pay attention, to this particular standard. I always say it, pay attention to it. If it is not tested as a standalone question, it can be tested under group account question, under complex group. So now let's break it down. Please note something. There's a particular concept, accounting concept that is playing crucial role in this particular standard, which is accrual basis. If you do not understand how to use accrual basis, then you cannot use IAS 19. So, we are actually applying the accrual basis of accounting here as a concept. So, such that the cost of providing benefits to employees is matched, or the cost of providing those particular benefits are matched to the period during which those employees have actually worked to earn those benefits. And that is why we say we are using accrual basis, and we're also using the matching concept. Do you know why this is so? Why is it that immediately you perform that particular, let's say for example now, let's say you are being paid salary, right? You have worked in that particular month to be paid your salary. Even if you have paid it or not, we are expected to recognize it in our books immediately. IAS 19 says recognize it, even if you have not paid that salary. recognize it immediately because of the person has actually served, has done that, satisfied that performance obligation such that it qualifies to be paid that salary. Are we making any sense at all? So you need to recognize it immediately, and that is the major reason why you will see that we'll recognize what wages or recognize salary expense depending on the general ledger that you're using for it, and you will now recognize what current liability. It is current liability because of you debit your expense account and you credit your liability account, which is current liability. Because the reason why we use current liability, when the place we use current liability to carry out that particular treatment is when it is a short term. I spoke about three classes of employee benefit now, right? I spoke about it. So how we can actually classify them. Now I spoke about the short term. I spoke about the long term, which can also be called the post-employment benefit, and I spoke about termination benefit. So if you want to actually recognize current liability, it's usually for the short-term liability, short-term benefits, because it's very certain that it will not exceed that year. It is short-term, and short-term are wages, their salaries, right? So how do you want me to recognize maybe a pension plan, a pension maybe like a pension payment, which is still going to occur in years to come under current liability? Are we getting what I'm trying to say? So in that particular year, we recognize them immediately as expense, and we also credit the liability. Don't worry, when we are doing the accounting, the remeasurement, and that's why we used to do a remeasurement. There's always a pension fund asset, and there's also the liability, right? When we are looking at the defined benefit plan. So I used to say I'm trying to like be in a hurry. This standard is a typical 3 hours standard. I will treat in my class, and I will solve about maybe 3 questions or 2 questions, and there's no how you will not understand it. Now, please note that the principle and the concept applies even when the benefits are paid in the future, just like I explained. Now, what is the recognition criteria? Many of us are used to the normal IAS recognition criteria: if the cost can be measured reliably and future economic benefits, if it's probable that truly, that's our anthem, ABC of standards. But IAS 19 has its own specific recognition criteria. One, it says that the liability is recognized when employee has provided a service. I said the other time that we are not waiting for when we are going to pay that particular before we recognize it. We are waiting for immediately that employee has performed that performance obligation. He has actually done what? He has provided that service in exchange. So liability is recognized when an employee has provided a service in exchange for a benefit that will be paid in the future. Please note that the basic double entry may be depending on the nature or the type of the employee benefit. So, for example, you can have debit employee cost, which can be charged to the expense in the statement of profit or loss, and you credit liability for employee benefit. And please also note that the expense must be accounted for on an accrual basis, and any unpaid entitlement should be recognized as a short-term liability, right? I'm talking about the short-term employee benefit now. That's what I'm talking about, the accounting treatment. So in a situation where you have not paid the salary of that staff in that particular month, and he has actually done the service that warrants him to collect that benefit, so you need to immediately recognize that a liability and an expense. Debit your expense, employee cost, credit liability, simple. I used to say something that if employee benefits, the standard just dealt with only short-term employee benefits, students will love it so much. But the standard did not really dwell much on short-term employee benefits. It went the reason I will tell you for a fact that the major reason why this particular standard was introduced is because of the post-employment benefits, right? Is because of the post-employment benefits. So all the things I've been explaining there for the short-term employee benefits, I spoke about wages and salary and all of that. Now, based on this, I said it earlier on that, have it at the back of your mind that IAS 19 was set up to treat post-employment benefits. This is, it's usually a special case that will be decided by the company's policy. I'm talking now, let me leave the post-employment benefit and let me explain the termination benefit. It's usually a special case, right? And whenever you are recognizing termination benefits, there are 3: short-term, post-employment benefit, which is also long-term, and the termination. Now, termination is maybe in a situation where immediately you have terminated that employment, the contract of that employment, right, of that employee, you need to recognize it. That's if there's a clause there to pay the amount. So the amount that you are going to pay will be the amount that you have actually had in the contract package of the employee. So it's that I said it's decided by the company's policy, on maybe it's a summary dismissal or maybe it's a termination of employment. There are some people that will say if it is a summary dismissal, maybe for a gross misconduct or something, they will not pay you anything. But if they terminated it based on probably downsizing or maybe restructuring and all of that, then they will pay you. Do you get? So it depends on the policy. As I said, termination is usually based on the policies. But however, it is the decision taken by the manager that will determine, the accounting treatment. Now let's come back to the reason why IS-19 was established, which is the post-employment benefits. Now, when we talk about post-employment benefits, they are the employer benefits that are accruing to those particular employees after the completion of their employment. Simple. And the most significant post-employment benefit is the retirement pension. But we have some others like the life insurance, medical care. Also, I spoke about it earlier. Now, when we talk about accounting for post-employment benefits, that is where the bulk of the work is, and this is where students usually start to find IS-19 really tasking or maybe boring, right? So let's do justice to it quickly. There are two types of post-employment benefits. Namely, we have the defined contribution plans, and we have the defined benefit plan. Now, under the defined benefit plan, the employer will usually guarantee the amount of pension that its employees will receive after they retire. Now, if you are working with a company and they tell you at the end of your retirement, we will pay you 10 million naira, that is a defined benefit plan, right? So that's why I said under that particular defined benefit plan, the employer usually promise or they guarantee the amount of the pension that the employee will receive after they have retired. Now, on the contrary, defined contribution plan, I'm really rushing all of this. On the other hand, are usually post-employment benefit plan under which an entity pays a fixed contribution into separate entity. Now, that entity is usually called the fund, and many of us are really very, very familiar with this. An example is the contributory pension that we are doing now. Which Nigerian law regulates the contributory pension? I want to see if we are still familiar with this. I know you must have. All right, network is back. So one of my friends used to say that instead of him compressing what he has read and add more, that he will take what he has read and throw it away and leave space for others. It's actually very funny, but don't do that for ICAN, especially when you are moving from the skills to professional, because it is called skills for a reason. You have acquired the necessary skills that you need to work as a professional, right? So you'll not be spoon-fed again. Okay, I have someone raising their hand. Zabit Olayemi. You want to say something, ma? Okay. I don't think
Yeah,
probably that's it.
I want to say something. Hello, sir. Good evening, sir. Hello.
Huh? It's I don't know. I can barely hear you.
Hello. Okay. Hello. Good evening, sir. Hello. Can you hear me, sir?
Yes, I can hear you. It's just breaking a bit.
Yeah, because for like when 5 weeks now, and
Yes.
every week you always make a
I can't hear you again. What's happening? Can we all hear him? Probably it's for my hand here. Is it for my hand here? Probably we lost Mr. Zabi.
I don't think so. It's not only from your end.
Okay, sir. So let's ride on. Probably when he's back, I'll give him room to talk after the class. So I just want to round off on IS-19 and we are good to go. Right. So probably lost this connection. And so I was talking about the defined contribution plan. That it is a particular it's a particular system where the entity pays fixed contributions into a separate entity, and it's usually the employer will contribute, right, and the employee too will contribute. But I'm not looking at that of the employee. It's only that of the employer I'm looking at, right? So that's what we are considering here. We are not looking at that of the employee. The employee to be contributing his own too. That's a contributory pension scheme. So, and please note that we have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay, all employee benefits relating to employee service in that particular current or maybe prior period. So, which is not actually so under the defined benefit plan, because of the employer has actually guaranteed the employee that, this particular fund, we have so amounts at the end of your service year. So if it falls short, they need to give that particular deficit to make up for it. Are we together? So, but under the defined contributory plan, it is not so. Are we together? So an example of it is the contributory pension. Now, please pay attention. In a defined contribution plan, the employer pays an agreed amount of money, which is usually called the defined contribution, at regular intervals into a pension fund for the employee. Now, those particular contributions to the fund are invested to earn a return. So you are putting it there. It's not like you are putting it to be idle. You are earning a return on it. That's why we used to say return on plan assets. Are we together? So, and it increases the value of the fund. As such, when an employee retires, he or she is paid a pension out of that particular fund. Now, please note the contributions payable for the reporting period are usually charged to the profit or loss as an expense. It's usually called the employee costs. Are we making any sense at all? And when you have any unpaid, yes, it's usually charged to the profit or loss as an expense in that particular period, right? So you are the one that will know the amounts that you want to be putting at every interval, right? You want to be contributing. So if you contribute it to that particular fund, you debit that fund, you credit your liability, your pension fund liability, your obligations, right? Don't forget that your obligations will be increasing. Meanwhile, that fund so you are having two particular accounts there. You're having the obligation account and you're also having the plan asset accounts. That's the pension fund where you are contributing it to. So the pension fund account will be accruing interest. Are we together? Right? While the obligation account also will be accruing, it will be having a particular interest on it also. Are we together? So which is the remeasure? That's why we usually do a remeasurement. So any unpaid contribution at the end of the period will be shown in the statement of financial position as a liability, and any prepaid contribution will be shown as an asset. So please note that at the end of the day, if there are insufficient funds in that particular plan just to provide the employees with the guaranteed pension, then the employer must make up for that shortfall. What we are trying to say here is that the risk remains with the employer. And yes, and when we are dealing with a defined benefit plan, we cannot do without talking about a very important professional. That professional is called the actuarian. Now, who is the actuarian? Yeah, who is the actuarian? The actuarian is a highly qualified specialist, who is actually skilled in analyzing the financial impact or risk and uncertainty. You know that you don't know when you are measuring, when you are doing your measurements, there's usually an actuarial will tell you that, this particular fund will be enough to cover for the obligation and all of that. So what about in a situation where you need to pay more, right? You need to pay more than the amount that you're having in the obligation, or you are paying less. I don't know if you are trying to get what I'm trying. I will expatiate on it better. But the actuarial is one that will measure, okay, is there any risk that you in the future that you might pay more or you might pay less? And the actuarial would be the one to advise on the fixed amount to be contributed towards the plan in order to be sufficient to pay the post-employment benefits. So it is the actuarial that will tell you that, why don't you contribute? Like in my office now, what we used to do is there's something called RRFA, Retirement Redemption Fund Accounts. That's what we call it. So in every month, we have actually assessed an actuarial, and the actuarial has told us that we should pay 10% of the total gross pay for every month into that particular plan. So what we used to do is every month we calculate all the total gross pay of the employee, of all our employers, of all our employees, and we look at 10% of it. So it's 10% that we used to use to fund, right? We normally used to fund that particular retirement redemption fund. So what about, you know, that the actuarial is the one that have told us that we should use 10%. In a situation whereby the actuarial now assess the obligations every year, we are told to do a remeasurement of the obligation. So we want to look at, okay, is there an actuarial loss or an actuarial gain such that the amount that we are having in our retirement fund account can pay and it will be in excess of the obligations that we are having. I don't know if you are getting what I'm trying to say. So it is very unlikely that the actuarial estimates will be 100%. So whenever the value of the pension fund assets and the employer's pension obligations are measured, the company may find out that there is a deficit or a surplus. Are we together? So let's make it more explanatory. When the value of the employer's pension obligation are more than the pension fund asset, then it is said to be in deficit because of the obligations that you are having is more than what you are actually contributing in the fund, in that particular fund. So that means that it is having a deficit. And when the value of the investment in the pension fund is higher than the value of the employer's obligations to make future pension payments, then the fund is said to be in a surplus. Now, what do we mean by pension obligations? Pension obligations are simply the amount that the employers have worked for, which are liability to the employer. That the employees have worked for, which are actually a liability to the employer. And yes, and it will be paid in the future. Now, when we talk about the pension fund assets, the pension fund assets, on the other hand, is where the employer is actually accumulating its funds every month, periodically. Some people might say they don't want to do it every month. They might say they want to do it every quarter and all of that. You get? So that's where he's storing that fund in order to meet with those obligations. If it does not put those that fund in place, when the obligations falls due, you will not be able to pay. Are we together? So he is actually putting that particular fund there in order to meet with those obligations when they arise. And the funniest thing about all of this is that the obligations do not arise together. Are you getting what I'm trying to say?
Yeah.
Imagine an employee retires today. They will go out of that fund and pay. Are we together? Anything that you pay out of that fund, you have to go and credit that fund. And the beauty of this is that when you are doing remeasurement in IAS 19, if you are actually debiting, if you are crediting your fund assets, you need to go and credit your obligations because of anything that you pay out of the fund assets. That means any obligation that you pay out of the fund assets must have reduced the obligation. That means that you are no longer owing that employee rather. Yes, you are no longer having any obligation to pay that employee. Are we making any sense at all? You know, this particular topic is very, very interesting. If we get to have time to treat it. So that's why I say always read through, watch the video lecture so that you can have a full knowledge of what we are talking about. Are we getting? So time is really ticking fast. And what should be now? The question that we need to be asking ourselves now is, if a life question comes now, the question will tell you, prepare, do a remeasurement, right? Do a POA extract, do a statement of financial position extract, do a statement of OCI, right? POA and OCI extract, right? So now that is why I used to tell students that you need to understand what are the things that will be in your POL, what are the things that will be in your OCI, and what are the things that will be in your statement of profit, statement of financial position. So what should be recognized in each of the financial statements with respect to a defined benefit plan? So starting with the statement of profit or loss and other comprehensive income, what we usually recognize in statement of profit and loss are usually items with respect to service costs. So service cost, we usually recognize it service cost. That service cost is those particular services that they've actually worked for that you need to pay post-employment benefit on, right? That's one. Then two, we also have net interest on the net defined benefits liability. Net interest on the net defined benefit liability. What do I mean by net interest on the net defined benefit liability? At the end of the day, if you look at the interest that is accruing, don't forget that all those obligations, you need to discount it to present value. So when you discount it to their present value, you need to be unfolding interest, those interest that you have discounted on it every year. You know, those particular obligations are shown at present value. You cannot show it with future this thing. Now you need to bring it back to present value, isn't it? So if you have discounted it using the cost of capital of the company, you need to actually unfold it every year, unwind it every year. So that interest that you are using to unwind those obligations every year, if you compare that interest with the interest that you are that the pension fund assets is bringing in, when you net it together, that is what, if it is a deficit, then you know it to be an expense in your profit or loss. If it's a surplus, then you know it is an income. That means that for it to be in surplus, that means that the interest that your pension fund asset have actually accrued in that particular year is higher than the interest that the pension fund obligation has actually unfolded wound on. Are we together? So that's what we are actually talking about. We also have, you know, when I talk about then that's the only two things that will go there to the profit or loss is the service cost and the net interest on the net defined benefit liability. Then for OCI, you have your remeasurement of the net defined benefit liability. You must have seen this in the question, how we treat it in the video lectures, how to do a remeasurement. Please just go there, remeasurement. You look at how we used to do a remeasurement of the net defined benefit liability. And please note that the service cost can either be current or past service cost. So service costs are those, like I explained, are those employee benefits we are to pay for the services that have been rendered by the employee. Now, when we talk about the current service cost, it relates to increases in the present value of the defined benefit obligation resulting from employee during the period, right? What those employees have worked for during that particular period, that's the current service cost. Are we together? And it's usually taken towards the P of L, like I said. So it's usually under service cost. So that's why I said under service cost, you have the current service cost, and you also have the past service cost. Now, when we talk about the past service cost, it relates to the change in the obligation relating to the services in prior periods. Are we together? It might not be in that current period, right? It's usually in prior periods. You know, this results from amendments or public curtailment to the pension cost. Maybe in previous periods, we do not recognize a particular current service costs that we should have recognized. It will be brought as a past service cost now. Do you get? That's what we mean by past service cost. It relates to services in prior periods. That's what we are trying to say. And lastly, service costs could also include any gain or loss on settlement altogether. So now, how do we carry out, you know, a remeasurement of the net defined benefit liability? So the remeasurement of the net defined benefit liability usually comprise of, you know, time has gone, the actuarial gain or loss, the return on the planned asset, you know, excluding the amount in net interest on the defined benefit, then any change in the effect of the asset ceiling, that's including the amount in the net. All of these are more explained, they are properly explained if, you know, we have questions. You understand this? Now, please note that usually in the funded defined benefit plan, the employer saves for the settlement on which he receives interest on, isn't it? And on the other hand, the obligation keeps, I explained this earlier on, that it keeps increasing by the rate at which we have actually discounted it to present value. So in the statement of financial position, which is the last one, what will be there? The amount that will be in the statement, the amount as a defined benefit liability is what will be in the what we are going to carry in the statement of financial position should be as follows: the present value of the defined obligation at the year end minus the fair value of the asset of the fair value of the assets of the plan as at the year end. That is, if there's any. So out of which the future obligation to current and past employees will be directly, you know, settled. You know, so I don't know how to, you know, all of questions. You would see that it will expose us to questions to more, right? So that's why I would usually it can be really you know, very, very challenging at times if you have not solved questions. But believe me, it has been treated in the video lectures and you are good to go on this area. So I'll be stopping here. I've used more than my time and we have even reduced. The call has reduced. That means that people have exceeded my time already. So many people have started leaving. So let's end it on this note. We have exhausted our time for today. So but before I go, please note that we have our video lectures for those of us that have not gotten the video lectures, and also ICAN past questions. It's always good to treat past questions, so it could actually aid your understanding more. The more you solve questions, the more you get exposed to those questions. So we also have our weekly ICAN questions on the members areas. So please treat the questions and drop your solutions there. And I would just do something quickly. Unveil the class, what we'll be having. Go through chapter 17 of your video lecture, so we can actually can ask questions ahead, and you can actually flow along in that class. So before I sign out, do we have any reservation, any comment, any question, and all of that? And the floor is open to us now. Let me stop presenting. The floor is open.
You gave concerning the advice you gave. Hello? Hello, can you hear me? Hello, sir.
Josephine is okay. You didn't get the chapters we should study for the next lecture. So that's chapter 17. Chapter 17. Chapter 17. Financial instruments. All right. Is there any other thing you want to say?
Okay.
Yes,
sir, can
ma.
you hear me?
Yes, I can hear you clearly.
Okay, concerning the advice you gave, like if it's advisable to write a CR